Hello and welcome to Investment Insight. Before we begin, make sure to subscribe and hit the like button. Now let's break down what's happening in the markets today in a clear and simple way.
Thanks for having me. I'm really excited to dig into this one.
Yeah, it's going to be a fascinating deep dive today. So to start us off, I want you to imagine like a teenager in Buenos Aires buying a quick lunch using a digital dollar on their smartphone.
Right.
Or, a factory worker in South Africa sending a piece of their paycheck to their family using a mobile app.
Which happens millions of times a day.
Exactly. But what most people don't realize is that those tiny everyday transactions are actually acting like a microscopic bailout for the United States government.
Yeah, it sounds completely like financial fiction, honestly.
It really does. But we're going to see how those digital dollars are actually helping to plug a hole in a massive $40 trillion national debt crisis.
Yeah, and according to recent analysis, this isn't an accident. It's a very real, highly orchestrated redesign of the global financial plumbing.
Right, happening right beneath our feet. So today, our mission for this deep dive is to untangle this whole web for you.
Because, understanding this redesign explains that crazy $40 trillion milestone we just crossed.
Yeah, so let's start right there with the numbers, because they are starting to look like typos at this point.
Oh, absolutely. August 19, 2026 is definitely going down as a watershed moment.
That was the day it happened, right?
Exactly. Based on the data, that was the exact day the total U.S. federal debt breached $40 trillion.
40 trillion. It's a staggering number.
It really is. It landed at roughly 40.047 trillion, to be exact. And if we break that down, the publicly held portion of that debt sits at around 32 trillion.
Right. But it's not even the total debt that's the scariest part, is it?
No, not at all. The most jarring figure in the data is actually the annual interest expense.
Just the cost to service the debt.
Right. Not paying down a single penny of the principal. Just the interest alone has crossed $1 trillion a year.
Wow. $1 trillion in pure interest. That just fundamentally alters the fiscal math of the whole country.
It absolutely does.
Especially when you consider that the U.S. deficit is currently stuck at about 6% of our GDP.
Yeah, and historically, you only see a deficit running that hot during, a severe economic crash.
Right, like the 2008 financial crisis.
Exactly, or during a massive mobilization like World War II, where the government is just forcibly injecting money to keep the economy afloat.
But we aren't in a recession right now.
No, we're not. Technically, the economy is expanding. So running a 6% deficit during an expansion means our structural spending is permanently outstripping our revenue.
It's like a snowball just compounding as it rolls down a hill.
Right, and there's no cyclical recovery coming to naturally close that gap. The Treasury is basically facing a permanent funding need, right at a time when borrowing costs are historically high.
Which brings us to this crazy maneuver the Treasury pulled on that exact same day, August 19.
Yeah, the timing on that was definitely not a coincidence.
So they announced they were doubling their buybacks of long-term bonds, specifically targeting the 10 to 20 and 20 to 30-year maturity ranges.
Right. They bumped the buybacks from $2 billion to at least $4 billion per session.
And right before they made this announcement, 30-year yields had spiked to 5.34%.
Which is a level we hadn't seen since 2007.
Wow. And then the announcement drops and yields briefly pull back.
Yeah, because the Treasury was essentially trying to put a ceiling on those long-term yields.
Because things start breaking if they get too high, right?
Exactly. When yields on 30-year bonds cross that 5.3% threshold, the broader economy starts to crack.
Like regular people feel it.
Oh, for sure. Mortgages become completely unaffordable for everyday Americans. Corporate borrowing just freezes up, and the cost of funding that $40 trillion government debt becomes mathematically unsustainable.
So the buybacks were just a direct intervention to create demand for long-term bonds and push those yields back down.
Right, exactly.
Okay, but let me puzzle through the mechanics of this with you, because my initial thought is always the credit card analogy.
Sure, yeah.
Wait, so is the government just paying off its credit card?
No. That's the catch. They can't just print money for this like the Federal Reserve does for quantitative easing.
Right, because they're running a 6% deficit, so they clearly don't have extra cash lying around.
Exactly. If they're buying back 30-year bonds, they have to be getting the money to do that by issuing new debt somewhere else.
So they aren't actually extinguishing the debt?
No, not at all. They are just moving it from one maturity bucket to another. They're entirely reshaping the debt profile.
Okay, so if it's not paying off a credit card, how should we think about it?
Think of it like a homeowner who is trapped in a massive 30-year fixed-rate mortgage.
Okay.
And the interest rate on that long-term mortgage is brutally high because the market is pricing in 3 decades of inflation risk.
Right. No one knows what inflation will be in 20 years.
Exactly. So the homeowner decides the monthly payments are suffocating them. They just can't do it.
So what do?
They swap that 30-year fixed mortgage for a series of short-term, 1-year adjustable rate loans.
Oh, I see. So the principal balance on the house remains totally identical. They still owe the exact same amount of money.
Yep, they haven't paid down the house at all.
They've just engineered a lower immediate payment by stripping away what they call the term premium, right? That extra yield investors demand to lock their money up for 30 years.
You nailed it. The government is absorbing that long-term risk from the market by retiring those 30-year bonds.
But to fund that, they have to flood the market with short-term debt, mostly Treasury bills.
Right. So the immediate interest burden drops, but the Treasury takes on a staggering amount of short-term refinancing risk.
Because they have to keep paying off that short-term debt and borrowing again.
Exactly. They're committing to rolling over trillions of dollars of debt on a constant rotating basis.
Just hoping that short-term rates stay low every time a bill matures.
Which is a huge gamble.
And that strategy creates a massive, glaring logistical problem.
Oh, a massive one.
Because if the Treasury is pivoting away from long-term bonds and aggressively financing the government through short-term IOUs, they need a buyer.
Right.
Who on earth is going to buy all these short-term IOUs? Because pension funds and insurance companies, they want long-term duration, right?
Exactly. They don't want short-term stuff. So who is on the other side of this trade absorbing all these Treasury bills?
Well, according to the data we looked at, it's actually stablecoins.
Yeah, which is just wild to think about.
The government is basically relying on the architecture of digital currency to create a captive market for its short-term debt.
Right, and the foundational piece of this architecture is the Genius Act, which was signed into law in July 2025.
Right, the Genius Act,
Right.
which essentially rewrote the regulatory framework for digital dollars.
It did. It mandated that any payment stablecoin must be backed one-to-one by highly liquid reserve assets.
But the hidden mechanism, the real lever in the legislation, is what they call the 93-day rule.
Yeah, that's the kicker. That rule dictates that the reserve assets backing these stablecoins must have a maturity of 93 days or less.
So we are talking about overnight repo agreements, cash, and most importantly, short-term U.S. Treasury bills.
Exactly.
So the Genius Act is essentially building a massive engine. By forcing stablecoin issuers to hold these reserves, it creates a mechanical guaranteed demand for short-term U.S. debt. But an engine is useless without a road to drive on, right?
That is a perfect analogy. Yes, the engine needs a road.
And if stablecoins are going to absorb trillions in U.S. debt, they can't exist purely in some random crypto wallet.
No, they have to integrate with the traditional financial system. And that infrastructure, the road for this engine, takes the shape of the Clarity Act.
Ah, the Clarity Act.
Yeah. This bill is designed to allow traditional, heavily regulated brokers, dealers, and national exchanges to legally custody and trade these digital assets.
So it connects the digital stablecoin ecosystem directly to the traditional Wall Street plumbing.
Exactly. Now, the House actually passed this bill decisively back in July 2025. The margin was 294 to 134.
But it's been totally stalled in the Senate since then, right?
Right. Which brings a completely new context to that White House meeting that happens on August 19, 2026.
Oh, wow, right. The exact same day, the debt crossed 40 trillion and the Treasury doubled its buybacks.
Yep. On that specific day, President Trump summoned major crypto CEOs to the White House.
Right. Executives from Coinbase, Robinhood, Kraken, and IC were all there.
And the explicit public goal of that meeting was for the administration to push for the passage of the Clarity Act.
They were trying to force this road to be built.
Exactly. The urgency from the administration aligns perfectly with the Treasury's dilemma.
Because if the U.S. is going to rely on short-term debt, they desperately need the Clarity Act passed, so traditional financial institutions can handle the massive stablecoin volume required to buy that debt.
And the data shows that this volume isn't just speculative crypto trading anymore. It's heavily driven by actual real-world utility.
Right. The Visa data from the recent analysis is just wild when you look at the growth curve.
It's explosive. Retail stablecoin volume was basically a rounding error in 2019, sitting at just $500 million.
And by 2025?
By 2025, it had exploded to $69.8 billion.
Wow. And the composition of those transactions completely flipped, didn't it?
It did. By late 2025, fiat-backed stablecoin purchases processed via Visa actually surpassed traditional crypto purchases.
Which means people aren't just using it to buy Bitcoin anymore.
No, they're using it as money. And the most revealing metric in that Visa data is the transaction size.
Let me guess, it's pretty small.
Yeah, the average stablecoin transaction was under $100.
That's fascinating. So this is not institutional capital moving giant blocks of wealth.
Not at all. This is grassroots adoption in emerging markets.
Like the examples we talked about earlier, people in Brazil, Mexico, South Africa using them for daily remittances.
Exactly. They're escaping local currency volatility and just trying to preserve their everyday savings.
Which brings this entire master plan into focus. I mean, Treasury Secretary Scott Bessent has openly discussed the potential for the stablecoin market to reach $3 trillion.
Right. The objective here goes way beyond just creating a friendly regulatory environment for tech companies.
It's way bigger than that.
It is. The objective is to fundamentally redesign the dollar system to fund the deficit.
Think back to that teenager in Argentina or the worker in South Africa we mentioned.
Right. When they hold a digital dollar on their smartphone, they are basically opting into the U.S. financial ecosystem without needing a Wall Street brokerage account.
And because of the Genius Act, every digital dollar sitting on their phone is backed by a short-term U.S. Treasury bill.
Exactly. So the U.S. government is bypassing foreign central banks, bypassing domestic pension funds, and tapping directly into the micro-savings of everyday global citizens.
They are essentially turning anyone with a smartphone and an internet connection into an indirect buyer of the American national debt.
It is an unprecedented pipeline for sovereign funding.
Truly.
It monetizes this global demand for dollar stability and funnels it directly into the Treasury's short-term borrowing requirements.
Okay, but I have to play the skeptic here for a minute.
Lay it on me.
Structurally, it sounds like an incredibly elegant solution to a massive fiscal problem. You issue short-term debt, force stablecoins to buy it, and let global retail demand fund the government.
Right. It sounds perfect on paper.
But looking at the actual market reaction, it doesn't seem to be working right now to actually lower rates, does it?
No. The market reality is pretty brutal, actually.
Let's look at the aftermath of those August 19 Treasury buybacks.
Yeah, so the announcement initially achieved its goal. It lowered the 30-year yield by about 7 basis points.
But by August 21st, literally a mere 48 hours later, the yield had retraced the entire move.
Right back up to 5.28%.
The market completely rejected the intervention in 2 days. Why did that happen?
Because the fundamental math just doesn't support the maneuver.
Right.
A $14 billion increase in buybacks is just a drop in the bucket against a $32 trillion publicly held debt market.
You can engineer the maturity profile all you want, but you cannot hide a structural 6% deficit from bond vigilantes.
Exactly. Investors look at the aggregate supply of debt hitting the market, and they just refuse to lock up capital for 30 years without a massive premium.
And I guess the stablecoin engine simply lacks the horsepower to absorb the current supply right now?
Yeah, it's just a size issue at the moment. A 2026 study from the Richmond Fed actually analyzed this exact dynamic.
What did they find?
They concluded that over a long enough time horizon, stablecoins definitely possess the potential to lower rates by generating vast new demand for safe haven assets.
Right.
But they also referenced a 2025 study from their own branch that warned the current market capitalization of stablecoins is just far too small to exert meaningful downward pressure on the broader Treasury market today.
So it's basically a bridge being built for the future, but the Treasury desperately needs funding today.
Precisely. And they are fighting these bond market fires on multiple international fronts at the same time.
Which brings us to Japan. Look at what Treasury Secretary Bessent was doing in late July and early August of 2026.
Yeah, he was in close coordination with Japan to actively defend the yen.
And this is all connected, Rick.
Extremely connected. Japan is one of the largest foreign creditors to the United States.
They hold a massive portfolio of U.S. Treasuries.
Right. And the U.S. Treasury is acutely aware that if the Japanese yen depreciates too violently, Japanese institutions and the Bank of Japan will be forced to intervene in the currency markets.
And to get the dollars necessary to buy yen and prop up their currency, Japan would have to liquidate their holdings of U.S. Treasuries.
Which would be catastrophic for the U.S. debt reshaping strategy.
Right, because the U.S. is delicately buying back long-term bonds domestically to suppress yields.
And if Japan suddenly dumps hundreds of billions of dollars of treasuries onto the open market, it would instantly overwhelm the U.S. buyback program.
Sending yields rocketing higher all over again.
Exactly. The Treasury is basically attempting to engineer a soft landing while juggling chainsaws.
Wow, that's quite an image. But it's accurate. They are trying to cultivate domestic demand through stablecoin legislation while simultaneously managing international currency volatility.
Just to prevent their largest foreign investors from triggering a bond market crash.
So let's follow this to its logical conclusion, because I want to know about the risks for you, our listener.
Sure.
When the government attempts to reshape $40 trillion of sovereign debt while running a persistent 6% deficit, what happens if this delicate balance slips or goes wrong?
Well, the most immediate threat is rollover risk.
Returning to our mortgage analogy earlier.
Right. Funding permanent structural obligations. Things like infrastructure, defense, entitlements with short-term debt leaves the government entirely exposed to interest rate volatility.
Because the Treasury has to constantly return to the market to borrow new money just to pay off the maturing bills.
Exactly. If an external shock causes short-term rates to spike, the interest expense compounds violently, which accelerates the deficit even further.
And the crazy part is, the mechanism designed to prevent that the stablecoins themselves could easily become the catalyst for a crisis.
Oh, easily.
Yeah.
Because stablecoins are essentially digital checking accounts backing their deposits with treasuries.
Right.
So, if a macro event sparks a panic, and millions of global users simultaneously decide to redeem their stablecoins for local fiat currency, you have a classic bank run, but on a digital scale.
And to honor those redemptions, stablecoin issuers would be legally obligated to liquidate their reserve assets immediately.
Which means they would dump massive quantities of short-term U.S. treasuries onto the market all at once.
So the very system designed to act as a guaranteed safety net and buyer for U.S. debt would instantly transform into a forced seller.
Exactly. Crushing the price of treasury bills and sending short-term interest rates into the stratosphere.
A mechanism built for stability would become an engine for a massive liquidity shock.
It's a huge risk. And furthermore, this whole shift fundamentally alters the architecture of traditional commercial banking.
How so?
Well, if a significant portion of the population shifts their transactional cash out of traditional local checking accounts and into stablecoin applications on their phones.
Oh, traditional banks lose their primary source of cheap funding.
Exactly. The everyday deposits just evaporate.
Which would force those banks to borrow at much higher rates to fund their lending operations.
Right, completely restructuring the winners and losers in the financial sector.
And we are already seeing the market sort of price in the consequences of this financial engineering, aren't we?
Yeah, we are. When a sovereign entity aggressively manipulates its debt markets, like intervening to artificially suppress interest rates without addressing the underlying deficit, it erodes trust in the currency.
Right. It's the textbook definition of financial repression.
Exactly. Which perfectly explains the market behavior following that August 19 buyback announcement.
Yeah, the value of the dollar softened, while hard, non-sovereign assets like gold and Bitcoin immediately caught a bid and went up.
Because investors recognize the financial repression. They begin migrating their capital outside of the traditional government plumbing to protect their purchasing power.
It makes sense. The broader the manipulation of the bond market, the stronger the incentive for capital to seek refuge in alternative assets.
Right, assets that cannot be engineered by a central bank or a treasury department.
Okay, let's pull all these threads together for our listeners because the sheer scale of this operation is staggering.
It really is.
Based on the analysis, the United States is actively re-architecting the global financial system to manage a $40 trillion debt burden.
Yes.
Facing a persistent 6% deficit, the Treasury is attempting to cap long-term borrowing costs by shifting the national debt into short-term IOUs.
And to absorb that massive supply of short-term debt, they are utilizing the Genius Act to legally mandate that stablecoins hold treasuries as reserves.
Right. And through this digital infrastructure, the government is bypassing traditional institutions. They're transforming the everyday micro-savings of global citizens from Argentina to South Africa into a captive funding mechanism for the United States.
It is a breathtakingly ambitious strategy.
It really is. But it rests on a fragile foundation. They're trading long-term stability for acute short-term rollover risk, all while the structural deficit remains completely unaddressed.
Yeah, it completely changes how you look at the entire digital economy.
It definitely does. As we wrap up this deep dive, I want to pivot to the broader implications of what we've uncovered today. What is the one final provocative thought our listeners should continue pulling on as this plays out in the markets?
Well, for me, the most profound implication here is the shifting balance of power.
How do you mean?
Think about it. If the U.S. government becomes highly dependent on stablecoin networks to fund its national debt, we cross a remarkable threshold.
Okay.
What happens when a private technology company in Silicon Valley, running the world's largest stablecoin network, suddenly holds more leverage over U.S. interest rates and debt liquidity than the traditional Wall Street banks?
Oh, wow.
Right. If a tech startup becomes the marginal buyer of sovereign debt, we have to ask ourselves, who is truly in control of the American economy at that point?
A private tech company holding the keys to sovereign bond liquidity. That fundamentally redefines the relationship between Silicon Valley and Washington. Something definitely worth mulling over. Don't forget to subscribe and hit that like button.